didn't tell me we were on live.
And your own show.
What up, what up, what up? Why am I not showing? There we go.
Hey guys.
Hey guys, what up, what up?
It's your show.
It is my show. You too animated. What up, guys? Just go. Oh, okay. All right.
What's up, family? What's up, family? Thank you so much for joining us. We're super excited. Everybody give a thumbs up if you could hear us. Make sure you could hear us on this end. We have an awesome Cocktails with Curt tonight.
Yep.
You guys have heard about, inflation, interest rates. Is it a good time to buy? Is it not? So we figured
we could bring in an expert. Bring in an expert.
Have a mortgage lender, one of our favorites, Mortgage Mario.
He should be joining
us.
Yeah, he should be joining us.
He'll be joining us here in a second. And we thought, we would jump
Alicia
on
joined. Hey, Alicia.
Alicia, what's going on, fam? She just celebrated a birthday.
I know.
Lisa. Looking beautiful.
As always. Mortgage Mario's trying to join.
Let's see if I could add him.
All right.
Invite to join. Here we go.
Let's see if that works.
There he is.
Hey, sorry about that. I kept clicking request to join and nothing was happening for me.
Oh, no problem.
Yeah.
We figured it out on our end.
Yeah. But how are y'all doing tonight?
Good. We got our cocktails. What you got? What are you drinking tonight?
I'm drinking a little bit of vodka with it's like a little Mario cocktail here. Got a little vodka, got a little seltzer water, keeping it light in the calories, and just like a little splash of pineapple juice. So
actually,
I gotta watch out for all the sugar. So yeah, it's an
yeah, no, actually similar. We're doing Ciroc and just some like light cranberry mango or cranberry pineapple kind of thing. So
ooh.
You actually got my.
That's good. Yeah.
Oh wait, switch.
Yeah.
Sorry, wrong glass.
Yeah.
Yeah, this is the strong one. This is the real glass right here. So
yeah. Yeah. Well, cheers.
Cheers.
Yeah. But I hope business is going well and everything. And
it is.
Yeah.
And guys, let us know in the comments what you guys are drinking. I hope you brought a cocktail because it's going to be a really, really good conversation tonight. Mortgage Mario is going to be dropping some gems. Everybody's always hitting us up in the DMs about, can I do this? How much, do I need to qualify for this? And so bringing the expert, I think, is going to be, we're in for a good show.
Yeah, when it comes to buying a house, unless you're a cash buyer, 9.9%, 9.9 out of 10
They're out there.
times.
Yeah, they're out there.
You're going to need this guy to help you with that. Before we jump in, I want to just do an introduction and kind of so you guys know who you see on your screen and tell
and who matters.
And who matters. So actually, we met Mario ironically through other clients of ours, Nikki, right? And
yeah, we don't have to say name.
Oh, Nikki. Yeah. Who's gonna know Nikki?
Oh, that's true. It's a lot of Nickies.
Yeah.
This is true. Okay.
And they actually met Mario. I remember the story that they told me, at least, was they met you at an open house.
Yep.
And they were currently working with another lender, and Mario being
Mortgage
Mario.
They had the guy, and then I came in, I wooed him. So
yeah, so that's what Mario
But the
does.
lesson is, guys, you have to shop around. You have to shop around for good service. That means, not if you're under contract with anybody. Let me just clarify that.
Well, even that, because that was the situation.
Yeah. But still, you have to shop around and make sure that you're getting the service that you should be getting,
right.
Especially making a purchase like a home.
Right.
You know what I mean? So
when we met Mario at closing, we actually were very impressed. Curt actually had put him through the ring.
Wait, can we back up for a second? And so, 'cause I think Mario can kind of tell this story. And so I think the people that are following us, a lot of you guys know, you follow us and, we always appreciate that. But, you kind of get the kid glove guy with Mark and you always just get straight to the punch with me. And so that's real life. So Mario, our very first conversation, I'm going to let him kind of describe what that interaction was like when our client, who was under contract with another lender, decided to switch lenders and do business with Mario. As a realtor, we have to know who's involved with the transaction. So I reached out to Mario, and what was said, sir?
Yeah, so he reached out to me. The one thing I did respect about Curt is that he was protecting his client, and obviously there are a lot of good lenders out there, and there's also a lot of bad lenders out there.
Yeah.
And so obviously Curt and I didn't have a relationship at the time, and so when he reached out to me, he's kind of like, you're kind of like the bad cop, and Mark's kind of the good cop. Is kind of the way I see y'all's relationships. Y'all definitely make a good relationship. You're definitely hounding me, and you're making sure that I was saying things. And I think you said verbatim, quote unquote, you're not going to say like blow this deal and say, hey, gotcha, or something like that is what you said. So, I did describe without that fiduciary law. Obviously, I am held by fiduciary law when someone lets me look into their financial portfolio and analyze things with them. But I pretty much did, details to Curt without breaking fiduciary law, and explain to him that, hey, I've got you. We've got them really already approved in underwriting. We've got everything teed up where there's other third parties in a real estate transaction that a competent lender has to stay on top of things. There are things that I don't specifically control, like the appraisal, homeowners insurance, title work, and things of that nature, but a lender manages that to kind of finesse the deal and streamline the process and get our borrower, we call them borrowers to realtors, they're buyers. So our clients are borrowers. So we're able to get our borrowers to the closing table in a stress-free, seamless process, which ultimately with like big bank lenders and online lenders, they're so saturated with so many borrowers that that they kind of miss the whole point of the process, and it's to close on the transaction.
Yes.
Yeah.
So
that's the ultimate goal. I mean, having had so many, I've been doing this now. I'm aging myself for about 20 years. You can imagine I've met, dozens and dozens, and people try to wine you and dine you as a realtor of why they're the best and why they have the best programs. And when we met Mario, especially at closing, and most importantly, talking to our clients to see how their experience was. And, part of lending is, certain lenders are going to have better programs than others. But in general, like, you're not going to see one, if you have like a 740 credit score, one's going to give you like, in a traditional mortgage, 6%, and one's going to give you a 3%. It doesn't really work like that. Like, it's tied to all these indexes, which we'll get into. But it really comes down to me, and I know to you, is customer service, knowledgeable lender, and not the 9-to-5 lender. Somebody that really delves deep when you need them.
Somebody that is almost like borderline personalizes your deal, right? Because you want, and that's our whole branding, welcome to the family, is that it's like we treat everybody like they're our only client, and you want to make sure you're working with the lender who makes you feel kind of the same way, right? There are lenders out there where they send you a pre-approval and you don't hear from them again. You're lucky if the agent hears from them again 5 days before closing, right? So with Mario, it wasn't like that. He was on it. He got his closed in like 2 weeks.
He was really, really good.
Yeah.
So as part of this introduction, just tell the people out there, your years of experience, and a little bit about Affinity Home Lending.
Yeah, so I have 3 experience in lending, and so prior to that, I graduated with my business degree from Kennesaw State University, and I was doing a lot of basically I was a self-employed marketing and sales, and actually I've represented about 400 plus doctors helping market their services. And so ultimately, kind of during Corona, that completely shut my book of business. And that's when I ultimately went into full-time into the world. That actually one of my very good friends, who is the broker at Affinity Home Lending and the owner and the president, DJ Stunts, that's when he brought me on full-time, because I had to make a a pivot wise, just because obviously Corona shut down a lot of different small businesses, the pandemic. So so I got in lending. He kind of showed me the ropes, and from the years experience that I've been there, I've learned from a lot of veterans. There are a lot of veterans at Affinity Home Lending that have been in lending, have been in diapers. And I did introduce y'all to Eric Hesse, who's been like in lending for 30 years, on a lot of deals and things like that. He's been mentoring me the process, and another guy that works for the company, Lou Berdillis. He's been, I mean, I don't want to ask him how old he is, but but he works on me and Jason every deal. We've got so many different safeguards in place. So the loan officer, I'm kind of the initial buffer on the deal, because I'm gonna analyze things like debt to income ratio, your assets and your credit health, and gonna kind of analyze loan products and different loan markets, whether it's government sponsored enterprises or non-QM mortgage markets and things of that nature. And kind of the first line of defense, but what Mike has done, he's created like a juggernaut of a team, because DJ's been in lending for 25 years. So he's been anywhere from a very expensive lender that has a lot of overhead that kind of rips people off rate, to the cheapest lender possible, that is going to kind of wrap up loans and throw them into third-party processors that probably don't know how to speak very good English. And so he was able to kind of see the good and the bad and the ugly in the loan world over his career, 25 years being lending. And so a big thing is people want a rate. Like, end of the day, you want a great rate. So that's very important. So we've got.
Well, speaking of rate,
I want to jump right into
perfect transition into speaking of rate. I'm sure everybody.
And I just want to say before we get into it, Curt is going to take questions as you guys have them. We'll try to fit it in and weave them in throughout. So if you guys have any questions, put them in the comment section and we'll try to get into it. But actually, you could see we actually formulated a lot of questions that were sent in, and just things that have been in the news, and I think things that would be helpful to the average consumer out there. So Mario, today the Fed raised the rates 0.75%. People want to know, how does that correlate to mortgages? Does it? They're hearing all these things on the news, the nightly news. That was like the lead story. So tell the people how it correlates,
or if it doesn't, and if it doesn't.
So yeah, it's interesting. So everyone on the message right now, let me know if you think that after the Fed hike, if mortgage rates went up or down. So I'm just curious to see what they think is going on. What kind of?
So in the comments, guys, do you think that rates went down today for mortgages, or did they go up?
Go up, because the Fed hike, it was 0.75% increase today. Do you think that they went up or went down? And don't Google.
And don't Google.
Yeah,
okay.
Let's make this interactive, guys. Let's just have fun with it. What do you?
So we got 2 ups. 2 people said up. 3 people said up.
Yep.
4 to 4.
We have a realtor that says up too, so this will be good too. We have another real estate professional.
Alicia said down.
Said down.
This shows you how the general population has no idea how mortgage rates work. They actually went down, and I was actually anticipating. I don't want to sound be Captain Hindsight here, but I was actually anticipating them to go down a little bit. I had a client that was wanting to lock. I want to lock, and I was like, actually, I think you should float. And actually, the last Fed hike, mortgage rates went down, and the reason being is because that when the Fed is trying to combat inflation. Inflation is literally out of control, and so basically by them increasing the Fed rate, that makes it more expensive to borrow money, and inflation is directly correlated with mortgage rates. So when essentially that they're making borrow more expensive to money more expensive to borrow, that inflation's actually going to come down a little more control, and that actually gives lenders on the secondary mortgage market, actually gives them a little bit more security, and that's actually going to bring down, believe it or not. So
guys, that's a huge point. So when you're hearing the Fed rate, you not always, but just you'll probably, once you start seeing that inflation starting to come down, that's what they're trying to get in balance.
Yeah, and
so what? So rates started the day higher and then ended lower.
Ended a little bit lower, so actually opened about 0.13% basis points higher, and then ended up coming down. I'll have to analyze. I didn't have a chance to see exactly how far down, but they did come down. And just to let you know that 1 basis point's 0.1%, or a point is actually a whole percent, like of a loan amount. So 100 basis points is 1 point. So that's mortgage terminology right there. So mortgage rates are so, actually, people think that the Fed hike has a direct, now Fed hike and inflation and the economy all do affect mortgage rates. That absolutely does affect mortgage rates, but they think that the Fed is what has the direct impact on mortgage rates. And actually, where you can analyze mortgage rates and have, what the behavior and trend lines of mortgage rates are going to be, just for your traditional GSEs like the Fannie Mae and Freddie 30-year fixes, is actually going to be more based off of like treasury bonds, like the 10-year treasury yield and things of that nature. And so they're directly correlated with that. And now kind of the explanation for that is basically when the 10-year treasury yield goes up, mortgage rates actually tend to follow. Okay. When it goes down, they tend to go down. So they're positively correlated, and people want to know a reason. Why is that? Why would the bond markets affect that? Well, mortgage-backed securities are an form of an investment. Banks actually, what they do is when clients come up to a bank, they sell them a mortgage. They qualify them according to the Dodd-Frank law that Obama passed and went through in 2010. But they basically have all the payroll laws now that they satisfy, and they basically sell them a mortgage, and based off, it's largely credit based. So like, obviously you have a better credit score, you're going to have a better rate, lower, worse rate. And so basically they'll sell these on the primary mortgage market, which is a customer coming directly for a mortgage. They'll sell that to the client, and they'll actually put this in a better portfolio, and they'll sell that at a discounted rate on the secondary mortgage. So they're called MBSs. And so the reason why they're selling at a discounted rate, because they're selling that off, and they're making money off selling that, and investors are yielding interest off of that. But now those are based off people paying their mortgage. So people in the primary mortgage market actually maintain their job and not foreclosing on their property. But the bank is selling that MBS off, and they actually take no risk. They get their sell, they get their paycheck, and if that portfolio goes to hell, they have no risk whatsoever. Their sell is made, it's done. Yeah. So there's some risk involved there on MBSs. So treasury bonds and things of that nature are some of the safest things an investor can. If you go buy a bond, like for your bond to not yield, there literally has to be World War III, and the government would just have to be taken over or something like that. It yields the least amount of interest, less risk, less return, more risk, more return. That's finance 101. We're taking finance class. Now, what happens is when we see that these bonds that are actually increasing for various reasons, a big thing is inflation causes that, economic growth causes that, interest rates and things like that nature cause that. And so what happens is that they actually, if a government bond is yielding so much interest, that investors are actually going to demand for MBSs to yield more, if that makes sense. So it wouldn't make any sense for a higher risk MBS to yield less than a bond. So that pushes rates up, and that's why that is the main reason why they're just directly correlated.
How did you? A lot of our followers, a lot of people are freaking out right now about rates, right? So, have you seen when the end of the year they were pretty much 2s, a little 3s. Now they've gone up, obviously now to the 6s. I think a lot of people, the biggest question is, where do you see the rates the rest of the year, like early 2020? I know you can't absolutely predict from what you're hearing, and the people in your office and everybody that's been years of experience. Where do they see rates going?
Just kind of stabilizing for a little.
1 second, let me look at my crystal ball here really quick. And if I knew exactly what rates we're gonna do, we would be on a yacht right now. We'd be having a good time in the, you know, in the Bahamas or something like that. So now, with that said, obviously we can analyze things from a macro perspective, and there's actually what let y'all know. There's a guy that I am really good friends with. His name's Ben Nye. I call him Ben Nye, the finance guy. But he works for like a hedge fund company. He's a like senior financial analyst, and he works with obviously high wealth investors. So the decisions he makes on a daily basis can make or break people in the millions of dollars and cents. So, but I really do on a probably maybe twice a month I follow up with him and kind of pick his brain, and then it does help me inform my clients and your clients in making smart financial decisions, and it kind of reduces the fear, and fear prevents people from making any type of purchase decision. When people
Absolutely.
they get tight and they just don't make a decision. So that's basically the most important thing, is to be able to educate and reduce that fear. So that said, it's tough. It's tough. So don't, you know, people don't
hold Mario to a certain
Yeah, but that is the $1 million question. I mean, so many people, you know what it is? Here's what it is. So I think for first time home buyers especially, that is a big concern for them, right?
Yeah.
For folks that have kind of, you know, bought a home here or there, you know, they've done it a time or two, like they're not really freaking out as much. I'm sure you're probably seeing that on the mortgage side as well. I mean, you kind of know that even at a 6% rate, that's not really anything that's high considering what historically what the rates have been. But I think for the first time home buyers, when they started saving, they probably started saving when they saw 3%, 3.5%, 2.99. And so now for them, they're like sticker shock, like, wait a minute, it just doubled in probably the 1 to 2 years it took me to save, you know. So now I think they're just like, well, maybe this real estate thing isn't for me.
Right.
And maybe for them, they don't know when to jump in, because if they're seeing the rates constantly going up, they're like, well, do I jump in now or do I wait? Are they going to fall? Like,
just a couple quick stories on that, just to kind of give you guys, because a lot of people just discovered us. A lot of people have been following us since 2014. Just a few like really, really quick stories. So I bought my first house in 2002 when I was 24 years old. And I've bought 13 houses in my name or together. Probably
I got good credit too, yo. Right. I really do.
Over the last, so that was 2002, so that's 20 years. I cannot tell you, other than the last 2 homes that I bought, what interest rate I paid for it. I can tell you I've made thousands of dollars on the sale of them or turned them into rental properties, because I was a responsible buyer and I was a responsible, educated buyer. So looking back today, I was looking, okay, what were the rates in 2002? And it looked like they were hovering between like 4.25 and about 5, right? And so flash forward to the COVID happening, right? COVID happened. Everybody was saying, oh my God, right? When it first started happening, oh my God, I'm not buying a house. The world's ending. Things are closing down. I'm never going to be able to, there's going to be a ton of job losses, all that kind of stuff, right? One other example, 2008, the market really did crash. I was a part of it. I obviously as a realtor and an investor and all that kind of stuff. What happened during that time period was horrible job market, the derivative situation with the mortgage-backed securities. Lenders were very, very lax, and Mario could talk about this and why there's rules involved in Dodd-Frank and all that kind of stuff if you want to get that deep into it. But it was a culmination of everything falling apart. Now you have all these mixed signals in the economy, right? You have a very, very strong jobs market. So people actually, I think when I was watching the Fed announcement today, there's actually 2 job openings for every 1 person. So like you have this data where anybody really could demand the salary that if they're in the right field. They're begging people to, to hire people and stuff like that. But you also have this incredibly strong housing market. And but then you have the other side of inflation and higher interest rates and stuff like that. So my message to you is don't get just caught up in the daily headlines of high interest rates or, housing market has gone down 2.9%, month over month, because when it went up 30% in some markets over the last year, that was not sustainable, right?
And most buyers couldn't even compete in that market.
So I think the overall message and what we want to get through with Mario tonight is, yes, we're going to talk about interest rates, we'll talk about credit, we'll talk about all those things, but find your affordability, your price point, and adjust accordingly.
To transition, again, perfect timing.
Yep.
I must say.
Yep.
I'm moderating this shit very well.
Very well.
And also find your. What's that?
Right now, I say you're not drinking as much as I thought you would right now.
You don't know how much I had before. That's the thing. But no, find all those things that Mark said, but also find your loan type and your loan product.
Yes.
And I think this here, if you guys if stay tuned, go tell a friend to join, because
this is really important.
This is really important stuff. So traditionally speaking, when you come to us or any other realtor, we probably said, to get pre-approved, you need to have, your W-2, your tax or your pay stubs, if you're 1099, 2 years of tax filings. And a lot of people didn't really fall into that category, right? And so for a lot of them, they remained stuck, or they lost money dealing with, people they shouldn't have been dealing with.
They had a break because of COVID. They had maybe a 5-month period where
and so there were all these different scenarios that kind of put people on the sidelines from being able to move forward with purchasing a home. But I like to say a Mortgage Mario because it's like a superhero / like comic book character. But anyway, but Mortgage Mario has got some really, really cool. And
talk a little bit about the difference between being a traditional mortgage lender and what you are, and what.
Well, let him tell the people who he is. I mean, that would be better.
Yeah, so we are local. We're based off of Marietta Square. And I was born in West Cobb, and I went to Harrison High School, and Atlanta, Georgia native, and we're considered a non-depository institution, which means that we're licensed mortgage professionals that, first of all, like a loan officer at a bank, no disrespect to them or anything like that, but they actually don't have to even get licensed in mortgages since they're considered a depository institution. So I actually had to go through kind of almost like a miniature college as far as getting, pre-licensed, and I had education. And then the only products that we have to sell are mortgages. So that's on a daily basis. That's what we do. The bank, you can get a credit card. They can try to get you to, banks really want money is what they want in the day. They use mortgage to kind of draw you in, but they really want you to make large deposits. And if you're kind of a loan officer at a bank, people are walking in, and they're going to be higher volume than me. And they're kind of salaried employees, so they're not going to be quite as motivated for their clients and their referral partners, builders, to basically to make it a fast closing and make it stress-free and just to make it a seamless process. They basically, people, they've got managers that expect them to have so much book of business, so many things on a board. And so they're kind of yes people. They'll tell you, yes, we can do it. Yes, we got them pre-approved. Yes, we've been doing everything in very high volume. Don't have the man hours, the manpower to actually do the job in the right fashion. And on top of that, they're 9 to 5 salary employees. So when they're off the clock, they're just not going to be quite as motivated. And then any realtor, even just Mark and Curt can tell you that they burned by banks, that they basically aren't analyzing properly, not pre-approving people properly. And that can cost money. That can cost you earnest money and cost you all sorts of things. So we pride ourselves on basically getting you approved in a TBD fashion, have really awesome cutting edge technology where we can get you approved in 15 minutes. And what that does is it builds trust.
You hear that, guys? 15 minutes.
Documents in, I can structure my underwriting team software, and then we just need a binding contract. So we need basically a seller and buyer to shake hands on a purchase price, and then we just need homeowners insurance. We need title work. And we may or not need appraisal. Sometimes we get what's called a PIW, which Fannie and Freddie will actually give us what's called an appraisal waiver on a subject property, and we can even waive having even do appraisal, which will streamline the process and make it much more seamless. So,
so I want to like kind of in a fast fashion kind of go down some of these programs just so that we can knock them out, because people have been hitting us up about it and there's different circumstances, and just kind of do like a 1 minute, if you can. I know it's hard, like a 1 minute like little blurb on them, and then we could kind of jump into the process and stuff like that. So a lot of people hit us up. Let's just use these terms. FHA. What are you looking for in an FHA mortgage?
So FHA mortgage, lower credit, lower income type of borrower, and then you'll have a more favorable interest versus.
And how much down payment for that?
3.5% down.
Okay.
Yeah.
VA.
Wait. Before we get this, minimum credit score?
Yes.
So you can go down as a 550, but in good conscience, I would really want you to 620 or get more favorable terms.
You hear that, guys?
Yeah.
There's going to be a lot of, like we've talked about, good lenders.
I just want to take, like, seriously. So real quick. So guys, as you said, as low as a 550, but really a 620 is where you should be to really be in the game. So if you know that you're not there, like, get yourself together first before you hit up a mortgage lender seeking out a pre-approval. Because a lot of you guys know that you have not been paying your bills on time, and yet you're still trying to get a house. So, like, just be honest with yourself. Get your stuff together. Get at least a 620, really a 640, honestly, and then hit us up. All right?
Yep.
Go ahead.
Hit Mario.
Hit Mario. Yeah, don't hit us up.
And
Hit Mario.
First of all, I've got on my website. They'll actually give you like 10 tips on how to increase credit. So that could be a whole nother Instagram video with you and us.
Yeah, we'll definitely add that to you guys. We'll explain.
Yeah, I'll send that.
VA loan.
So those are sexy because people think those are government loans. That's actually just basically guaranteed by the government 25%, but it's still coming from a private institution, the money. So, but that's 0% down. And since it's guaranteed 25%, you actually don't have what's called private mortgage insurance, which on other loan products that you actually have to pay a monthly payment and you put down less 20%.
Are there any limits to a VA loan, like price points or anything like that?
What's that?
Any price point limits for VA, or could it go?
Yeah, they went up. We went up to about 2 million on those. So, I mean, that's never an issue. And then we've got jumbo VAs that can go even higher. So, but yeah.
So, and then is it just military personnel, spouses, like who's qualifies for that?
So yeah, so you would have to, your spouse would have to be in the military. So yeah, if you weren't married, and you basically couldn't go VA. There's unique circumstances where you can have a co-borrower on a VA loan. So normally speaking, you go 0% down with a VA. And once that, I wanted to co-borrow with someone and I'm not actually married to the person, and I'm not a veteran, then there's actually unique circumstances to basically have the eligibility for, I can actually put down 12.5%. And so that's one move to borrowers. I know a lot of lenders don't even know that. And again, that's just me being licensed and educated that I know the rules.
Okay. Let's talk about some non-traditional bank statement loans. What are those? How many bank statements do you need to provide? What's that process look like?
And what's the minimum qualifying criteria, I guess?
Yeah. So the only time you really would want to go bank statement is it's typically for self-employed individuals that write off everything on their taxes. So they basically don't want to pay anything in taxes. And so you can't get a government sponsored enterprise loan if you're not showing any type of like qualifying income. Okay. Because they want to pay your taxes. So basically writing off everything. If you're generating a lot of cash flow, but you're writing a lot of things, we can actually, it's a private portfolio loan. It's considered a non-qualified mortgage, and we can actually create qualifying income through cash flow on bank statements. So we wouldn't actually be looking at income documents or anything of that nature. We typically will look at 12 to 24 bank statements. So they assume a 50% write-off expense ratio. So, you know, if you're depositing 20K a month in a bank account, then we'd go by 10, and we can actually go with a lower 20-30% expense ratio if we get a CPA or there's an enrolled agent, I believe, a form of a CPA, just to get technical, is actually able to provide us a certified letter to basically say that's what they're writing off.
Okay.
Yeah, those are pretty sexy, and they are going to be a higher interest rate. I mean, I would say rule of thumb is they're going to be 1% higher than a Fannie or Freddie loan. And people go, why would I pay that? Well, you can't even qualify for a Fannie or Freddie loan.
Right. Well, is there credit score? Do you need a credit score to qualify for that, or is it purely based off of your your
Bank
income,
statement.
your bank statement?
Yeah, it depends on the investor, but in good conscience, I want to have my clients at about 680 FICO on that, because it's not as favorable. But then what I do to kind of bring reassurance to my clients, when, you know, obviously everyone gets butthurt when their interest rate's a little bit higher than their buddy, you know, next door to them, right? But I go, you're writing everything off your taxes. Let's say that you didn't write it. How much money would you be paying in taxes?
Right.
Well, then let's do the differential. How much more money are you paying to have a slightly rate? Well, it's input output. Well,
It makes sense
for us.
you're saving way more money by paying a slightly higher interest rate and writing everything off your taxes, and that nips in the butt for those people when I explain that to them.
And yeah, because, you know, we learned a lot from you, and I think talking to Eric, because, you know, we actually, you know, trying to become customers too of Affinity, and we're learning a lot of this along the way. So, you know, you guys had heard us talk for years, and Mario does probably have this program too, where it's 2 years of your 1099, and they're looking at your profit and loss. And there are some people that have made that transition from corporate America and started a business and stuff like that, and it's been going on for a year. And they did try to do a lot of tax write-offs. So if they say even made 150,000, but show that they wrote off 150,000, right, to save on taxes. If you go that 1099 route, you're going to show with a profit and loss 0. It's hard to qualify somebody to show 0 income. So this is a program that really enlightened us. One question I had on it though, so somebody gets a bank statement loan and say they get 1% higher than today's rate. So say they get it for 7%. Say 3 years down the line, rates come back down to 5 or 4, and they want to refinance. How does that work in a refinance in a bank statement loan?
So they can do refinances on bank statement loans, or if they could get a new job, maybe they went and got a salary job, you know, and then now they actually have qualifying income, and then rates get sexier, then we just refinance the Fannie Mae loan, and then their interest rate's really sexy. So that could be an option right there. So
a question that came through, and I wanted to know this too. So is a bank statement loan the same as a no doc loan?
No, so a no doc loan, that is essentially, so we will not collect any type of tax returns or W-2s or anything like that. We're essentially we need your assets. You're gonna have to put a down payment, and those loans are always gonna be a heftier down payment. You're gonna have to put down at least 20%, because it is a riskier loan to the investor. So but you definitely want to put down about 20-25%. And essentially, we're going to order a special appraisal on the property. We're going to order what's called a 1007 appraisal, and we're going to fair market rental value analysis of the property. And so they're called DSCR loans, debt service credit ratio loans. They essentially want that to be a wash with whatever the mortgage is. So, you know, if basically your mortgage is $2,000 and they come out with a fair market rental analysis around, you know, $2,000, then that satisfies the lender's rules. And again, those are private portfolios, so those aren't on the GSEs. They don't have all these rules. They're applied to Dodd-Frank. That doesn't apply to these ability to repay laws. That's private money, so they're able to just basically do whatever they want.
It sounds like, if I'm following it, it sounds like it's minimal qualifications. You just really have to be almost like cash heavy in a sense, or be willing to pay the higher interest rate to kind of.
Yeah, I think it would work for somebody like you said that is 680 or higher. If you're in the 7s, I'm sure it's even stronger, and you can show you have that kind of money to put down.
But I think, to clarify, because we get a lot of this in the DMs, and I didn't really know, so I didn't know how to answer. It's like, so no, guys, a no doc loan does not mean
I have no job.
you can't have a job.
I got no money.
You have no money, and somebody's gonna get you a house some way, somehow. The same rules apply. You still have to have something, some skin in the game to be entertained.
Yeah, I mean, I wouldn't say that they're your everyday regular loan. Most people are doing FHA, VA, conventional. But people, people do hit us up.
People hit us up because they hear what their friend did. Right. Their friend might just be, and they hear different things. And so, like you said, when people hear that their neighbor got a lower interest rate, they want to know why didn't they, right? So if somebody had a no doc loan and didn't have to go through underwriting and all this other stuff, people are hitting us up like, well, hey, my friend said, and I don't know how to answer. So now
everybody's situation is totally different. We've run across people that make good money or a second job doing Uber or Lyft. We've had people that are bodyguards for celebrities and they get their money, different ways. So there's definitely, and then you have the regular corporate, regular everyday buyer. So everybody has different circumstances. And that's what Mario is going to, try to, pull out of you. What is your situation? What is your scenario? And how can we get there? Two more things I wanted to hit on. The medical profession. Any special programs for doctors, traveling nurses, chiropractors, dentists, anybody in that field?
Yeah, we have it where, 0% down, so you don't have to put as much down. And then obviously the big thing with, medical doctors is like, so, usually you have to have, work history when you're a medical doctor, but basically we can use like residency programs or even medical school to actually satisfy work history. So if they get right main job as a doctor, then it's not like they have to go work for 2 years or anything like that nature to satisfy that. So we're a little more lenient on that. And also you can actually exclude student loans, because I know obviously having to calculate student loan debt obligation.
Hear that, guys? That's big. That's big.
Yeah.
That's probably one of those questions that we have been getting, again, probably in 1 minute. If you could kind of describe all these things with the student loans, and all this has been in the news. People hear terms like income-based repayment. Like, what do you encourage people that aren't in that program, income-based, and how are you calculating that for student loans?
Yeah, so student loans have all their different rules depending on what money market you go on. One thing especially that people need to be aware of, that if someone was looking at a house last year, that the FHFA, Sandra Thompson, who's the director of the FHFA, that's the government entity that basically monitors the Fannie Mae, Freddie, FHA, VA, all these GSEs. They actually became more lenient on student loans and deferment. They were actually calculating about student loans and deferment at about 1%. So for basically every $100 in student loans you had, we would have to count a monthly debt obligation for one. They reduced that to 0.5%. I was able, when I was basically calling people in my pipeline, I was educating. I was like, look, I don't like being a sales guy. I like being the expert in mortgages. I hate selling you on something. But I know when we're talking, student loans was a big thing for you. The rule just came out. We're at 0.5%. Puts you at an eligible debt to income ratio, and you can go buy your house now. So, and that's where rules are changing. And we're, again, a good mortgage expert. Rules, underwriting guidelines more than I change shirts in a day. So you just got to we've got to stay on top of things. Rules come out all the time. And I know, even mentioned profit and loss statements, that was now during Corona and FHA. We actually, on self-employed, we eliminated that. We're not even P&Ls anymore. So that's another rule that just changed. So, and again, y'all aren't loan experts. So I don't expect y'all to know that. And y'all were aware that obviously during Corona times that P&Ls were an obligation, but a lot of times we don't even need that. So, but yeah, VA. For anyone that's VA and they have a lot of student loans, if it's in deferment and a lot of veterans don't know this, and veterans I've got basically on the phone with pre-approving them, that they just assume that we're gonna be able to buy a house with a lot of student loans. If it's in deferment for a year minimum after they close on the house, then we can actually put the student loans completely.
Oh, wow.
So, and I've seen too a lot of loan officers that aren't really educated. They've kind of messed up with their buyers and realtors that trust them with the pre-approval, because they'll see it in deferment and they won't even calculate any debt obligation. And then when the underwriter comes through and calculates that, then they'll go, we're supposed to do a debt obligation, and then it'll blow their DTI. It's not just actually pretty emotional happens, and then you'll get denied for a loan, which is why it's very important to approve by a loan officer that knows the rules like the back of their hand.
Very important. Very important. We get this question a lot, obviously, in this environment. And I know a lot of banks have been hitting us recently. Bank of America has been in the news about this too. Down payment assistance, grant programs. What does Affinity offer, and what are the qualifications for it?
Yeah, so we have some different down payment assistance programs. Usually, we'll give her some basically some credits at the closing table to help pay for closing costs and things of that nature. But yeah, and they can be in the form of, grants and or forgivable loans, or even just kind of like low loans and things like that. So, but a lot of times they're more for people that are lower income base and things of that nature. So obviously someone's making, $300,000 a year and they want a bunch of money.
The funny thing about it is, we get that a lot. Yeah. We have actual clients that are
buying like over $500,000.
Over $500,000 house. Say, hey, do I qualify for that loan program? I'm like, no.
If you qualify for a $500,000 loan,
yeah,
you're probably making like well over $100,000. Yes. Probably well over $150,000.
The program is not for you.
And so if you haven't been able to save,
yeah, it's not for you.
It's not. I want to talk a little bit about. So we're talking about rates being right now probably around the 6 range now. Talk a little bit about buy downs. How does that work? Do you feel like it's worth it in this environment? And how much does it cost to buy down a rate?
Yeah, so buy down, there's points, and this is why it's very misleading. Someone calls me, and first of all, I don't even know their name. They call me and go, what's my interest rate? I'm like,
that's really what people are.
So wait, that's what you get? We get like,
yeah.
How much would it cost for me to get this house? And I'm like, I don't even know who you are. Right. So.
And yeah, that's when we have to go, and we're kind of smart, Alex. That's kind of what we laugh about. Let me look at my crystal ball and just tell it, just telling you exactly how things are going to go. But yeah, points, that's where it's misleading. So you can actually pay points to buy down a rate. So 1 point is 1% of the loan amount. So essentially $100,000 loan amount, that's $1,000, and you can pay money to buy down a rate. And so you got to be careful on when lenders are quoting you on that, because some of them are feisty. I actually just beat a big bank on a quote that they had about $7,000 in points, and apples, mine was about $2,500. And wow. And that's where our closing costs are lower than other lenders right there. So,
I like apples to apples. So say you're buying a $300,000 house and it's a 6% interest rate, and you want to buy it down to 5%. What would that cost, and do you feel like it's worth it at all?
A good rule of thumb is, if you just want a rule of thumb on points, I would say probably for every point, buy it down 0.5%. So just for the sake of creating, and it really just depends, obviously, our the real estate world is just so complex that you cannot be very simplistic, but for simplicity purposes, we'll go with that. But personally, you basically take the payment of what you're saving on buying down with points, and you divide costs and points is, and that basically gives you amount of months it takes to recuperate your investment. And so essentially, if it's $1,000 in points, you're saving, $100 a month, we'll just say. Then after 10 months is your break. We call that a break even analysis. And then if you stay in there longer than 10 months, and you're saving, a ton of money off of rates. But normally, when I analyze it, it's not worth it. A lot of times with the points, with that one guy, I was telling my buddy, I was like, you're gonna have to live in the house for like 15 years. And I'm like, that's what I'm doing as a lender.
I agree with that.
So sold on the rate, and I was like, me giving you a higher rate, and actually went no points on it, because I was like, me giving you a higher rate right now, actually winning apples to apples compared to his loan, because your closing costs are going to so much higher. We can take that money, you can invest it, you can make interest off it. And ultimately, I personally think rates are going to come down. And the reason being is that what brings down interest rates, economic crisis, that money's going to be so expensive to borrow with all these Fed hikes. And so that's going to slow down our economy. There's going to be unemployment, things of that nature. There's not going to be economic growth. There aren't going to be things happening, really. People, we're just going to hold on during recessions. people spend their money on needs, groceries, and and their house and things like that. So they're not when there's not a lot of money going fluctuation.
Hello, we just had COVID, right? That's
Yeah.
why the rates went to 2.99 and everything else, because people were like, "Oh, pandemic, I'm not buying a house, and I'm not leaving the house," and so they had to figure out a way to keep everything, at least
From what I understand, like I said, I'm not an expert, but I've been doing this for 20 years, so I've seen.
I think you're going to say something totally different. I'm not an expert, but I play one. Yes, you do.
No, but like when I was describing, rates and all that kind of stuff, but obviously nobody saw a pandemic happening and stuff like that. And like I said, I'm not an expert in monetary policy or anything like that, but I think people just get uncomfortable with big shifts in rates and inflation, and then things never stay the same. Like, if that was always the case, the stock market would always go like this, the housing market would always go like this. It's about riding this out. That's why they have over a 30-year mortgage. You're going to see rates up, you're going to see down, you're going to see high unemployment, low unemployment. There's going to be all kinds of monetary policy, and if you always kept rates artificially low, then when there is a pandemic or a war or something going on and they need to help raise the economy, they have to be able to drop rates during that time. But if you're always like at 0 or at 1% or at negative, they have no monetary policy to affect the market. So what you guys are seeing, in what we're seeing in the market, and I guess this is where we can jump in as realtors, it was crazy. It was insane between January and probably around 4th of July, I would say. And actually, to be honest with you, even though we were doing gangbusters and we still are doing very well, it wasn't really fun, because you would have, we'd send people to Mario or any of our other lenders, and these were people that had worked hard and saved up for their 3.5% or 3% and did everything right and had 740 credit scores, and you take them out and there's 25 offers on a property within, the first 12 hours that it's listed. And on top of that, you've got investors swooping in. And I think there is something, I don't know what's going to happen. I don't know if the state or the federal government has to jump in, but there was just this influx of, because the rates were, still relatively low. You had OfferPad, Open Door, private investing companies. We had a couple of listings where we couldn't even show the house yet because investors were swooping in and saying, like, we'll give you no appraisal, no due diligence period. We'll give you $30,000 over the ask price. And as people at like our GreatHomesATL and our whole model is welcome to the family and giving advice like we have all these years, we were having consultations. We were taking people out. And to be honest with you, some people had dropped out of buying a house because it wasn't the interest rates. It wasn't that they had saved up enough money. It's just that they could not compete with
the market,
bidding wars, and people waiving their appraisals and going $80,000, $90,000 over the ask price. So that wasn't fair in my book, and it wasn't it. Part of what makes our economy and capitalism great is competition, and it became very much like a monopoly on just rich people and people that had a lot of money and investors. And I think what we're seeing now, and this is what the Fed is trying to do with the higher interest rates, is everybody take a step back. Let's get that inventory, supply, demand back aligned. And you may see a little dip in certain counties, certain states, year over year, sales and sales pricing. But we hear this all the time, collapse. A collapse in our book is like houses going for 50% off, 40% off. It's just not going to happen. The economics of what is going on. And so many times people are living on, we see it in our comments, in Jesus' name, I am going to win the lotto to get this house. And what we're trying to tell you is nothing's changed as far as it's starting to get back to even again, where if you're trying to do the right thing, like you are saving, you're getting your credit score where it needs to be, you got some reserves, or in the scenario of the bank statement loans and stuff like that, like just put yourself in a position and find your sweet spot. Find the properties that fit your budget.
No, I ask a lot of people this, clients and just people when I'm just, whatever, just bar talk or whatever. But what is inflation? Most people can't really even like answer that question. But essentially, in a nutshell, what inflation is when there's a lot of money in circulation and there's not a lot of supply, that's inflation. And so in a sense that why houses were extremely inflated in price, why they were going well over asking prices, because money was so easy to obtain. When rates are lower, it is so easy to borrow money. And so you've got everyone and their mother trying to buy a house.
Yeah.
Basically, COVID basically caused, a lot of supply chain issues. Houses are more expensive to build, things of that nature. A lot of sellers that actually would sell don't want to sell because they can't go buy, and that costs.
Right. Where are you going to go? Like, you can make all this profit, but
so like they go homeless. So they're actually sellers out there, but they're in hiding because they're like, we don't want to sell because we can't buy it.
Right.
That actually causes inflation in itself. So that's the problem with the Fed is they can control the rate, but they can't control supply. So like tensions in Ukraine and things like that, then if we're not controlling the supply, then basically there's going to be extremely high demand, and that's going to drive prices up. There's less something, and there's so many people wanting to buy that's still going to drive prices up, and we're still going to have, a form of inflation. And so that's a lot of experts think mortgage rates are going to kind of level out because meanwhile, we've basically what causes mortgage rates to drive down is that we have an collapse. We have a recession. It's not going to be anything major, but I think it's going to be kind of mild. That drives rates down. But the problem is that if there's still supply issues, that will still keep inflation high. And it's almost like we're getting into what do you call it, like a Mexican stand down or
right.
It's like, so they think rates kind of go up and down within a 0.5 to 1%.
Well, let me ask you this then. So would you, what would your advice be to someone that's going under contract now with, let's say, one scenario being a 45-day close or a 30-day close even. Let's say a 30-day close, 30 to 45 days, or someone building a new home and they have more like a 6 to 7 month close. What would your advice be as far as rate lock? And does Affinity offer those?
Yeah, we do offer that. We offer obviously the longer the lock, that can affect the rate, that will increase the rate because obviously the lender taking in the market. So
risk, yeah.
Obviously, like what if rates shoot way up? Well, then we were taking on that risk. So your initial lock's going to be a higher rate. So for people that are very nervous Nancy's about things, I mean, you can lock if you see your rate's it's going to be higher than obviously a 30-day lock. But gosh, if it was me buying new construction, I really think that they're probably going to level out to the mid, I would say, end of the year. My guess is 5s. I think that we're in a recession. That's going to cause that in itself causes rates to go down. All these Fed hikes are going to have to combat inflation, and things are going to have to tone down a little bit. So that
you have for the rate lock, is it a float down option?
Yeah, there's float down options where we can buy down the rate, because once it goes down so much that we can buy that down. So typically when it goes down to 0.25%, we can buy it down to 1/8%. So always, for people on especially resales, and you got a typical just 4-week contract, you see a rate you like, just lock and load. That's what I say. And then worst case scenario, it shoots way, then we have basically buy down option. And it's not the world, but and I also ask people too, I say on a scale of 1 to 10, how, if your rate goes down 0.25%, I always ask this question to a client when they want a floater. Like I say, if it goes down 0.25%, how, on a scale of 1 to 10, how happy you're gonna be? Oh, I'll be pretty happy, maybe a 6 or something. And I say, well, other way around, if it goes up a 0.25%, how pissed off are you gonna
be? Yeah.
10, and they go to 10, and I'm like, there's your answer. There's the math equation. You're gonna be more pissed off than happy. Just lock it.
Yeah, lock it in. And it's something psychological. And I think
Yeah.
that, people, and I get it. Like, it's, like I said, because we both have been doing this for a while now, and this is like second nature to us. So I know there's a lot of you out there that hear these terms, and we try to explain to people. People are so caught up on two things: credit scores and interest rates. And if literally one lender has piss poor, I won't name them, but there's some national lenders out there.
Pocket mortgage.
It rhymes with pocket mortgage.
Yeah. Spaceship logo mortgage company.
Picking loans.
Picking loans.
Yeah.
But people get caught up.
Freaking loans.
Freaking loans.
Freaking loans. That's what I was thinking.
But people get so caught up with why Mario quoted me this rockin' mortgage.
Pocket mortgage.
Pocket mortgage. Quoted me like 0.1% lower. So I'm going to go with them because their rate is lower. And then they get into this deal and the rate isn't ended up because they ended up not locking when they thought they did. Talk a little bit about, because you're local, because our clients are going to be Georgia residents, and most of them, or at least investors, some of them, compared to the big box retailers and like the other, even banks and stuff like that. What do you think, like strategically, and you yourself as a consumer, why do people get so caught up in like such a smidgen of a percent, and how much does that truly make in your mortgage payment if your rate, somebody quoted you 6 and somebody quoted you 6.1?
So it's all fictitious until you actually have a house by the rate. You're talking to lenders. Some just bait and switch. They're going to throw out low rates to just basically suck you in. And what they want to do is they want to get you so invested that ordered everything in, and basically have you for it. Then it's just too late to switch lenders. So like we've actually had a couple of officers that work for Rocket Mortgage, and the guy felt like he was selling their sales cycle, what they taught them. I mean, he felt like a total piece of crap, and he felt go to hell with what he was doing on basis to people. And so they are complete liars. I mean, I really like to talk crap about the competition, but they are just such piece of crap liars.
We've had deals with it's bad. It's really bad.
So bad. Like, I'm a nice guy and I won't go talk about crap about anyone, but they're just so bad that like a guy like he's just gonna say that. I see it all the time.
But does it just to give people an example of, again, great customer service, all those hidden fees that are involved, like what really would make a difference between 6.1 and 6.0? Like, what does that really mean in your mortgage compared to the points you might pay with some other ones?
Yeah, it really comes into peanuts. It comes in a couple bucks. And so another deal, I had a guy where basically I did a 5 point. He was putting 5% down. It was gonna be forever. Played PMI. He was gonna read by the time. And I can. Some of brokers, I can shop around for the lowest mortgage payment. So that's the advantage. Actually, I'll have to send you this. HMDA actually came with a statistic recently that mortgage brokers save borrowers on average $10,000 on their loan, so in closing costs. And that's straight from HMDA. So
wow.
I'm able to shop around and things of that nature. But this one, it was actually kind of mischievous because I had $70 PMI and his rate was like 5.79. He was like, the rate's lower. The guy was on the phone with me. The rate's lower. Just mad in the face. He explained. I was like, their PMI was $150 a month. So they were like $50 more. I mean, it came out to be, much more. And I was just like, dude, I'm like, all right. And I started just breaking in PMI factors. So if you want to get technical, take the monthly PMI, multiply by 12, and divide that by the loan amount. And that will give you your PMI factor. Add that to your rate. And then take another competitor's quote, take the interest rate and take their PMI factor. And it's actually going to be lower. Or you don't even have to do that. It's not very complicated. Add PMI plus principal and interest. And so you can actually have higher. In that case, I was like, dude, I've got the monthly payment beat down by a mile. The interest rate's actually higher. And that's where, again, rate actually didn't win right there. Do you want to, I just asked a very simple question. Do you want to pay $60 more a month with him, or would you rather save $60 a month? I was like, just answer the question.
Just answer that question, right?
Answer the question. I was like, then come to me. If you want to pay $6 more a month, go to him.
Yeah, I think the lesson in all that, guys, is like, the lesson in it is don't get so fixated. Like, if you want to buy a house, buy a house. If you're financially responsible, you've done all the homework, and this, what we've talked about, terms like this, PMI, points, discount points, lender credit. These are all factors that are more important than somebody can give you 0.1% less than somebody else. There's reasons behind it. There's government-backed loans. There's private equity loans. There's all these factors. So I want to wrap it up by just kind of giving you a shout out and also telling people how to get in touch with you. So as we wrap up here, we've put, Mario was great to create a link for us to associate with GreatHomesATL, also for Hope and Valerie, our other agents. And what we love about Mario is he's very much into automated, streamlined, 21st century processes that a lot of lenders that have been in the industry for 25, 30 years or more don't even know how to operate and get into Instagram. So he is very good at putting an automated process together. And what we're all about is this whole 360-degree holistic approach. You follow us on Instagram, on social media. You know that we require a pre-approval to schedule a consultation.
Can I just pause you for a second? I have to. I'm sorry.
Okay.
Pre-approvals, guys. Pre-approval.
The difference between
a pre-approval and a pre-qualification, one very, very easy thing. If you go on to your favorite bank.com and you put in whoever you want to be in real life on that application, and it gives you a letter that says congratulations, you are pre-qualified, or even if it says you are pre-approved for this amount, that is not a pre-approval. You want to have a conversation with a lender about your situation, that a computer just simply can't give you an output based on whatever you told it you wanted yourself to look like, number one. Right. Number two, goes back to accountability and being honest. Guys, we all know that some of us have made financial mistakes along the way of our journey called life, myself included. There's nothing wrong with that. What there is something wrong with is when you know that, and you know that you have just filed for bankruptcy less than 6 months ago, and you are filling out a pre-approval application. Don't waste people's time. Like, just don't do that. Like, you have more to figure out about how to manage your money than you should be prioritizing getting on the phone with a lender on how to borrow more money.
All our time is valuable.
Like, everybody's time is valuable, and we're all in the business of helping people. If you're serious about home ownership, we have the network of people that will get you there, but you have to be honest and you have to be ready to get in the game. Don't fool yourself. So when it comes to the pre-approval, have a conversation with the lender. Make sure that pre-approval, make sure you understand what's behind that number. Congratulations for whatever the amount is, but what's most important to you is going to be, what is the monthly payment that's affordable to you? Right. How much is your cash to close? What are your closing costs associated with that amount? So again, congratulations for the larger amount, but ask the lender what those other payments look like. And you can't get that information from going to your favorite bank.com and keying in a bunch of information and getting a pre-approval letter saying, hey, can we go look for houses? You can with somebody else, but not over here.
Yeah, we just talked an hour about these terms. Private mortgage insurance and W-2s and bank statements and medical loans and VA loans, right? There's so many different products to talk about. Probably some that you didn't even know. Some you might be a doctor and you didn't even know that there was this program, or you might be a veteran and didn't notice was this program. So we created this form, Mario did, where it's right there on our link tree on our Instagram, and you could fill it out. Mario will then reach out to you, go over the numbers, talk about a plan. If you're there, great. He's going to send a copy of the pre-approval letter to yourself and us that will prompt us to schedule a Zoom consultation with you. If you're not there, but you're close, maybe you're a little bit short, we're going to talk about, he's going to talk about different programs for lender credits, or it just might be like, hey, I'm expecting a bonus in March of 2023 when bonuses in my corporation are going to give it out. But you've had the conversation, you have the blueprint. Mario has all the software to set reminders and stuff to follow up with you, and we're going to get you there. Yep. So the final thing that I want to talk about, just the one thing that always bothers me.
Here we go. My glass is empty. How long is this going to take?
Is just I want to reiterate that you have to know where you're at to know where you're going, and that's where the team and what Mario and GreatHomesATL, we try to bring you this 360-degree holistic approach, so that you're not jumping from this one to this one and then trying to interview 5 different realtors and 5 different lenders. Like, we're trying to make it streamlined, organized, and well thought out process for you.
That wasn't that bad, actually.
Wasn't that bad, right?
That was not that bad.
Yeah. And the add-on about pre-approval letters from some of their banks, online lenders, to be honest with you, I've seen dirty pairs of underwear worth more than those pre-approval letters.
They're not worth the paper they're printed on, right?
It's absolutely pathetic. And so that actually helps you on getting, because first of all, you got to attain the asset. You want to get your offer accepted. And so we're local, like we get all of our business through word of mouth, so people trust us. And you look at our reviews, we have all 5-star reviews. And in the day, that there's something to be said about that, is like, okay, well, we're doing the right thing. You can hold us accountable. And if we ever do mess up, we will pay, we'll compensate the buyer for that. You know, if you pay, we really we would pay your earnest money back. You pay your moving, you wouldn't be out a cent.
You hear that, guys? That's really good. I didn't even know that. That's really something you stand by. And we're not to brag, we got 5-star reviews too.
Yeah.
No, but I think it's a great partnership that we formed. The feedback has been great. Like I said, it's a very streamlined process, and we're looking forward to.
I think we have to get some reels with Mario. That's what's next.
Yeah.
Are you ready for that, sir?
Let's do it. I want to do something kind of more. I like your funny reels, so I want to do something kind of funny. So
we've been so busy, and it's just kind of like get what I can get done. But I'm gonna get back to it though.
Yeah,
I'm getting back to it.
We'll do something kind of fun. I think we do definitely a funny skit. That's real estate would be.
All right, stay tuned.
Right.
But no, appreciate you dropping all the gems, spending your time with us. You know,
hopefully it was very educational. We'll post this on our page, so anybody that had to dip in and out, you could watch it.
We'll tag Mario in it. So if you guys, you want to hit him up, have a conversation. If you think you're ready, he's not into, what happened in your life 5 years ago. If you think you're ready, hit Mario up. Let's get you pre-approved. Let's get you into a house. We also sell houses too. So if you have a house you want to sell, hit us up for that as well.
Yep.
It's been fun. My glass is empty, but cheers, guys.
Cheers.
Yeah, cheers. Mine's empty.
Great conversation.
Appreciate you.
Thanks, Mario.
Take it easy, guys.
All right. Take care.